We've got the world riddled with investors who overlook bear markets by simply not paying attention. And guess what? They're still drowning in the loss that they had to endure. They could have taken simple action to protect their wealth, but unfortunately, fate had other ideas for them. But do you know what we have at our disposal? The power of now. One of the best financial advisors out there is Ben Carson. He has been carrying out extensive research on recent bear markets so that we can prepare in due time and in the best possible way when the devil knocks at our door. Looking at his blog, he has shared analyses on some bear markets since 1950. He has written 4 books, all containing extensive research about markets and how we can make the most out of them. In this video, we're going to bring forth some historical aspects of bear markets and how we can make the most out of them. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Technically, a bear market is a market that falls 20% or more. When we look at the peak and trough dates of the S&P 500, followed by the declining percentage during each bear market since 1950, we can also find out the duration of the unfolding bear markets, and similarly, the number of days taken by each bear market to return towards its previous high. Let us look at an example. The average bear market decline which has taken place since 1950 was a decline of 30.2%, and some of the bears also surpassed the 50% mark, which were the largest falls as we're moving towards 2023. Now, the S&P 500 has hit a decline low of somewhere around 19%, and technically speaking, this is not a bear situation, but it's very close. Bear markets are normal, and they should be expected. No doubt that they're painful for the uninformed. The reasons are always slightly different, but the emotions that come along are always the same. The negative takeaway is that no one knows how long the bear is going to haunt all the investors out there. But the positive takeaway is that at some stage, the bear is bound to make its way back to the jungle, at least for a good period. It is important to understand that once we understand these happenings in detail, our journey through these situations becomes increasingly productive and we can avert many of the losses. Now, a bear market can be measured across various indices as well. For example, the Nasdaq is down somewhere around 29% at the time of making this video, which puts it straight up in the bear's territory. Previous bear markets can also be seen concerning Nasdaq. The worst decline was somewhere around 77.9% during the notorious dot-com bubble in the year 2000. Overall, the average bear for the tech index has been around 37.6%. Now, Ben Carson demonstrates an approach to benefit from these declines significantly, and more or less that revolves around the technical definition of a bear market. That also means that value investors can consider buying the Nasdaq index every time it drops 20%. Many financial advisors also recommend buying into an index after a 25% decline before averaging in for a long-term position. We can use the 1990 bear market as an example to make things clearer. The stats revolving around the 90s bear shows that if we bought an index when it was 20% down, we would have made returns over 40%, and after 3 years we would have returned 102%, out to 10 years where we would have realized a profit of over 1,000%. To put it simply, the average return rate across all bear markets using this simple approach of buying at a 20% decline proved to be okay. The drawbacks of this simple strategy cannot be ignored. For example, when the situation leads to a major bear market, for example the dot-com crash of the 2000s, it would have seen you invested for more than 10 long years, and after all these years, you would have still ended in a negative territory. Now this is a serious cost to pay, but there is an alternative for literally every drawback out there. We can use a combination of the 20-week moving average and the weekly MACD. Too much terminology, right? A 20-week moving average is an indicator that calculates the average price over the last 20 weeks so that we can get some idea regarding the complexities in the market. It can filter out some serious noise from short-term price fluctuations. On the other hand, the MACD, the moving average convergence divergence, is also a trend indicator that can show us the relationship between two moving averages of a security's price. So the strategy simply goes as we can assume selling when the price goes below the 20-week moving average and re-entering when the price moves back above the 20-week moving average, but only if the weekly MACD line is also above the signal line, which is calculated from the 26-period moving average and the 12-period moving average. For example, let us take a look at the S&P 500 and the Nasdaq index. At first, we simply look at the decline percentages and the duration of capital employed for the S&P in comparison to a buy and hold approach. But before moving on, we want you to consider understanding all the stock categories in detail before you start employing these useful strategies in your investing journey. You don't have to rely on some old methods of analyzing stocks on the web. We've provided a free ebook in the link given in the description below, which will explain these 6 stock categories to you guys. Make sure you give it a look because everything starts with strengthening the foundation. Coming back to the strategy, let us first consider the S&P buy and hold approach. So we want to compare the maximum decline and duration of the S&P 500 since the bear markets of 1950 and compare them with the 20-week moving MACD approach. To ignore the complexities and the exhaustive work, we look back 35 years covering the last 8 bear markets since 1950. When we try readjusting the averages, we get a 31.5% average decline and an average decline duration of somewhere around 245 days if you took a buy and hold approach through each of the 8 bear markets. When we add the results from our alternative approach, we find out that now we were given an average decline of 10.9% during a bear market decline and an average decline duration before selling the position of 35 days. It is important to understand that within some of these bear markets, we would have re-entered and exited the index several times as per the strategy, with the dot-com bubble taking an average of 5 trades. The results improved significantly, but the biggest difference was the duration of having your capital tied up during each decline. This duration was reduced by a factor of 7, which is huge in terms of the opportunity cost. Notice that buy and hold would have tied you up for almost a year on average, whereas the other approach would have seen your capital committed for just over a month on average. Most people get so occupied by declines that they simply miss out on the bigger and more important aspects. Despite a history of economic mayhem, the markets somehow always seem to find a way to recover. However, during times of upheaval, there are times to mitigate the risk and make the most out of the situation. For some value investors, bear markets are danger zones, while other investors take them as regular days in the office or just as part of the business. Let us know about your views on bear markets in the comments section below. Tell us about your strategies with the unfolding of bear markets. One way or another, the moving average MACD approach is just one example of how you can mitigate risks during times of uncertainty. Check out the video we handpicked for you, and we'll see you in the next one.